Okay, I think we'll begin. Welcome to today's webinar, Decoding Sustainable Investing Strategies for the Canadian Market. My name is Marshall Beyer. I'm a Senior Director at the Canadian Securities Institute, a Moody's Analytics company. I am pleased to welcome you to this webinar. Before we begin and introduce the expert panelists, just a few housekeeping notes. The ratings or financial analysis, projections, and other observations constituting part of the information contained herein are and must be construed solely as statements of opinion and not statements of fact or recommendations to purchase, sell, or hold any securities. We ask that no one record this webinar without Moody's explicit written permission. Lastly, no one has permission to quote any of the comments made or questions asked by the webinar audience. You should know, though, that Moody's is recording this webinar, and it will be made available. And I'll talk about that later on. The format of today's webinar is really a panel discussion and Q&A. All members of the audience are currently on mute. If you have a question, and we encourage you to ask questions, please type the questions in the Q&A box at the bottom of your screen. And we ask that you keep your questions as generic as possible and avoid personal or client-specific information. I will direct the questions to the panelists. This webinar hopefully will help better define sustainable investing, explore its trends and opportunities, help address some of the misconceptions around sustainable investing, and also articulate why it's important for investment advisors to be knowledgeable in this area. According to Morningstar, the number of sustainable investing funds, including ETFs, so ETFs and mutual funds, in the US has grown from around 100 in 2012 to 646 in 2023. And the net dollar inflows into these funds grew from around $5 billion in 2012 to $350 billion in 2021. In the last couple of years, however, there has been a slowing down of the inflows, and in fact, in 2023, there were significant outflows. As mentioned, this data is from Morningstar. So tremendous interest in sustainable investing, and we'll get into maybe some of the reasons why, but in recent years, maybe some slowdown in interest, and we'll talk about that as well. With us today, and we're very, very fortunate to have two very distinguished experts in the field. We have Olaf Weber. Olaf is a distinguished professor and holds the CIBC Chair in Sustainable Finance at the Schulich School of Business, where his research and teaching interests explore how stakeholders in the financial services industry contribute to sustainable development. He focuses on the role of voluntary and regulatory mechanisms in becoming more sustainable, social banking, and impact investing, the materiality of sustainability risks and opportunities for investors, and, if that's not enough, artificial intelligence as a tool to analyze environmental, social, and governance performance. We also have Nalini Fulaloli. Nalini is head of responsible investing at BMO Global Asset Management, as well as the board director at the Responsible Investing Association. She previously served as head of Canada for the UN-supported Principles for Responsible Investment. At BMO, Nalini is responsible for RI strategy and oversight of ESG integration, stewardship, and thought leadership. Prior to this, Nalini covered pension funds, endowments, and foundations at BlackRock Canada, where she championed the firm's responsible investment initiatives locally. So I think we're going to begin maybe next slide, with the first topic, which is understanding sustainable versus responsible investing. And I think Olaf is going to take this one. And Olaf, I know over the years, and I think sustainable investing really goes back a number of decades right now. And it's been called many different things. maybe some subtle differences between the different names from socially responsible investing to ethical investing to impact investing to responsible investing and sustainable investing and investing using ESG factors. So can you maybe help maybe clarify the differences, if there are any, between all those terms, so we can sort of level the playing field?
Yeah, thanks, Marshall. And I think, yeah, there is a difference. So maybe starting with that, I think there's a difference between sustainable investing and responsible investing. However, we cannot say one is good and one is bad. So I think both is good. Both is good. So that's maybe a good point, a good starting point. So, of course, the field, as you said, is very heterogeneous and diverse. It's full of specific terms that might be confusing, and then also used differently by different actors. That's important to keep in mind. So I think we need to keep in mind that sustainable finance, sustainable investing, ESG, responsible investing are still relatively new fields. So in a way, this confusion that we have about the naming and all this, it's from my point of view at least, it's not caused intentionally, but it's because the field is not well defined yet. We have other fields, in finance and investment that are much better defined, and there we know exactly what we mean with certain words. But I think it's the whole development is still in flow. So let's have a look maybe at some of the big associations that use these keywords. So we have the principles for responsible investing. So that's a big association of institutional investors mainly. And then what they say is we will incorporate ESG issues into investment analysis and decision-making processes. We will be active owners, incorporate ESG into our ownership policies and practices. So what you see here, responsible investing for them means incorporating ESG issues in their decision-making. And I can go a bit more in detail a bit later. And so in addition to that, it's interesting because they say, as institutional investors, we have a duty to act in the best long-term interest of their beneficiaries. And in this fiduciary role, we believe that environmental, social, and corporate governance issues can affect the performance of investment portfolios. So it clearly says, this is not a nice add-on to have for people that are interested or that have a kind of moral obligations to do certain things in a way. But they say, it's a fiduciary duty that we have to do that, and that's important to keep in mind. If we have a look at Canada, and I think Marshall introduced Nalini as a board member of the Responsible Investment Association, and they define the responsible investing as referring to the incorporation of environmental, social, and governance factors, short ESG, into the selection and management of investment. So I think this is pretty clear what it means now. So responsible investment means to consider certain ESG factors in your investments decision and in investments behavior. So what does that mean? If we say we consider ESG into investment decisions, for if you have a fund that says, we are a responsible investment fund or an ESG fund. So what might that mean for them? In a way, incorporating ESG issues does not necessarily have a result in portfolios that are different from conventional portfolios. You can say, for instance, if you go for dinner this evening or the next or tomorrow, you can say you consider eating vegan. You consider that. That does not mean that you really do it. So it means you take into account, you have a look at the menu, at the ESG menu, and you analyze, the ESG menu in a way. But then still you can decide, I still pick certain stocks or whatever you put into your fund. And this might integrate there might be companies that you integrate because of their environmental performance or not. So you need to be careful here. So responsible investment considering ESG means mainly that you have a look on that at that. And so why can you do that? So responsible investment can have two causes mainly. First, you can do it to manage risks. And I think in both definitions, PRI and also RIA, they mention that. So you can analyze the investment. For instance, if you want to invest in an insurance company, you might assess their climate risk assessment activities as an E factor because you want to know whether they address climate-related risks of their clients in their home insurance policies. And of course, this is crucial for their financial performance. Probably you don't want to invest in an insurance company that doesn't consider E or is not good in considering environmental risks in this regard. For instance, if they have, insurance policies and in regions that are affected by climate change and extreme weather events. And secondly, you can use these ESG criteria because you want to avoid polluters, for instance, or companies that are low performance with regard to social issues, diversity and equity, for instance. So this might be because of moral views. You don't want to be invested in that. So you can use ESG and responsible investment to do that as well. At the end, you might invest in companies that are rather high with their environment and social and social performance. So usually this responsible investment is what kind of conventional investors do. For instance, pension funds. Most of the Canadian pension funds you will see if you look at their website. They will say we consider ESG, we do responsible investment. So what is sustainable investment to compare to responsible investment? And now it's already becoming tricky because if for instance, there's the CFA definitions that says that sustainable investing balances traditional investing with environmental, social, and governance related insights to improve long-term outcomes. So again, this looks like what we have seen before as responsible investment. And so the question, there's certain certain unclarity about that. So I would say for me, sustainable investing then is defined by addressing certain sustainability aspects through investments. So this might be investing in green energy, for instance, if we want to become more sustainable, transition to low carbon energy, we need to invest in green energy, for instance. We can invest in companies that support diversity, equity, and inclusion, for instance. Or on the other hand, we can see we do not want to invest in companies that have a negative impact on climate change. So from my point of view, in addition to the single materiality for the company that we have had before, in responsible investing mainly has a look at financial, at the risks and opportunities that come that come because of ESG criteria. I think we have here is more a double materiality aspect that also looks on the impact of the investment on sustainable development. And so I think from my point of view, sustainable investment does not only impact the financial bottom line, but also the externals, so environment and societal issues. So usually you call them externalities, and they're not included in financial decision making, convention at least. So the difference maybe for me, so if you say, again, the dinner, if you eat sustainability tonight, that means you eat food that has low negative impact, or might even support sustainable development coming from organic farming, from whatever type of source. So this is for me a main difference. So the difference here is you change you change your investment. So for instance, you might take the sustainable development goals and check how investments address these goals, whether it's in line or in contradiction to these goals. So some might already call this already impact investing, but I would say, I would in this case, I would say, sorry, I prefer the term sustainable investing for that. So I think that's kind of my point of view. And again, you see, CFA sees it differently, and others might see it differently. So, but I think this, from my point of view, these are the main differences between the two concepts.
Sorry, thank you, Olaf. And Nalini, do you see things differently?
Not entirely. Hello, everyone. I actually would support a lot of the references that Olaf made in terms of the CFA's view or the PRI's view of considering, ESG factors as part of the investment process, right? Part and parcel. I think there are levels by which you can prioritize them alongside other traditional factors. And I think that's when we really are able to delineate between terminology like impact or sustainable. But for me, if we were to just compare these two terms, sustainable investing or responsible investing, I think I would need more information before attributing a specific approach to either. So I would put these two terms kind of as synonymous personally within the asset management industry, but then kind of looking under the hood to understand if it's an ESG integration approach, which is just really analyzing these ESG factors alongside any other material factor, versus maybe a strategy that is actually trying to invest, to Olaf's point, in companies that are going to be resilient to the effects of climate change and are purposefully investing in solutions, like trying to basically solve sustainability challenges. So that's my short answer.
Okay, thank you very much. So, I think a lot of advisors sort of view whatever definition you use as, they're tasked with really delivering better returns for their clients, based on obviously the client's profile. And they're not, a lot aren't making a link between delivering better returns with sustainable investing. In fact, maybe some think it's inconsistent that you could achieve both. But I think generally that, and I'm maybe skipping a little bit ahead to misconceptions, but do you find that that is maybe a misconception that a lot of people who aren't, kind of as knowledgeable in the field, they automatically jump to that conclusion that those two goals of better returns versus contributing to the betterment of society, if I could use that term, are inconsistent. But I think what we're saying here is when you use ESG factors, it is entirely consistent that you are choosing companies that are that do meet standards in that area, and as a result, those companies are mitigating the risks and they are delivering better risk-adjusted returns, I guess, over the long haul. So just any comments on that?
Yes. I think it's still one of the biggest misconceptions in the field. I don't think there's a trade-off, so-called, between doing good and doing well. Green sustainable investing does not necessarily create lower returns. We have even cases on impact investing, that deliberately focus on certain social and environmental impact that create above market returns. So I think the main thing is we have good and bad financial managers in all types of investment. For instance, so I've been an advisor on an advisory board of a sustainable fund of funds, for instance, and there I have seen, there were good sustainable funds, from a financial point of view, and there were the bad ones. It's really, it depends on how you do it, and how you combine ESG or sustainability with your financial analysis as well. So I think we cannot say both. There's also this kind of notion sometimes that they say, oh, ESG always outperforms. No, probably not, but I think we can also say that, also not say that it always underperforms. Just keep in mind, if we have big regulations related to sustainability, we have the EU sustainability reporting and all these standards now. Of course, if you follow these regulations, you probably do better financially than not being able to follow them. And so I think this is a good example that shows, you can have both. And this is, of course, that's what clients should have a look at, what in, this specific products and services that are offered, how do they do in this regard? And also, what is your own attitude to that? So what do you want to see? There might be clients that want to see more environmental impact and maybe are willing to to sacrifice some financial performance. There might be others that go the other way. So yeah.
Right. Great. Okay. Thank you. Okay, I think we'll move on to the next.
Sorry, Marshall, can I just jump in?
Oh, yeah, no, please. Yeah, please do.
Yeah, just because, in terms of the advisor perspective, maybe I'll just drill down to two really quick things on that whole question around sacrificing returns. I think we need to think about two specific things and not label this entire field of responsible or sustainable investing with one brush. So if I were an advisor, I would look at the investment objective of whichever strategy I'm contemplating may or may not do this. So if the investment objective, for example, focuses on one particular sustainability theme or one ESG theme as being the priority strategy for that fund, that it could be that they're then therefore investing in a fund that reduces the investable universe. And there could be a trade-off because they're prioritizing one thing over another, over financial returns, for example. But separately, if the strategy in question has a regular investment objective akin to financial performance, but does look at ESG factors through a risk management lens, then perhaps that outcome in that specific situation is not at all, no trade-off whatsoever. They're just being a little bit more prudent and expanding their analysis. And finally, I would say timeline, right? Depending on the client in question, if you're working with a 30-something-year-old who has 30 more years until retirement, I think that person is going to want to make sure that their long-term interests are protected for retirement. And therefore, that's where a lot of sustainability and ESG risks play a bigger role, and you want them to be managed accordingly versus somebody who's probably going to retire in the next 5 to 10 years. I think you want to work with an asset manager who understands when these risks or factors will pay off, if that's outside of that timeline or, when they will actually take effect. So just trying to speak a little bit more in terms of the tactical considerations that managers can consider.
Right, great. Okay, so it will move to Canada here. Well, what is the current sustainable investing landscape in Canada? Is it different than it is in the United States? I did talk in my introduction about some maybe decline in interest, according to Morningstar, in terms of inflows into ETFs and mutual funds that fall under this category. Has there been in your any kind of pushback or a tremendous uptrend, of course, but maybe a little bit of moderating of that strong trend towards investments in this field? So first, I guess, is any differences between the Canadian and American landscapes, and if you want to comment as well on the trends that I gave earlier on in terms of inflows into this category of investing.
Yeah, I think Canada is pretty. If you look at the global landscape, it's kind of in the middle of the pack. Everything. No, it's not leading. It's not lagging. I think. So maybe starting with the outflows, we had a tremendous increase over the last year. So maybe that's the first, and so there might be some change in the investment. And for the outflows, we have to think about why do we see that. So on the one hand, of course, we see some of the mainly, from my point of view, politically driven arguments in the US. That some say if we use ESG, that it's kind of neglecting financial performance. And I think we have discussed that it's not the case. That you can't make the case for that. There's no way that you can do it. So, but of course, that's a kind of political, and that might be motivation for some to move out of these types of investment. Of course, another one is just the opposite side. I think there are also investors that thought or were, had the impression that the investments they do are much more sustainable or green than they thought. So, if they had seen, okay, that's an ESG fund, that's a sustainability fund, that's a green fund, then their impression was, okay, they go, only in green tech or whatever, and then they might realize, okay, it's not like that. It might be only ESG, and at the end, this portfolio is pretty conventional, and so I want to move out of that. This might be another reason why we see some outflows. A third one might be also that a lot of the conventional funds or kind of investments in the meantime use ESG as well. There are probably many approaches that we see now that we called ESG or responsible 5 years ago that are now pretty conventional. I guess that many investments just use ESG criteria even if they don't explicitly mention them. And I think, that's the BlackRock example as well. They say, we use it anyway, whether we call it ESG or not. So I think, this is kind of some of the explanation. I think one kind of maybe special case of Canada is that, of course, we have an economy that is more dependent on resources and especially also fossil fuel resources. And of course, this creates some issues as well. So if you are in a country that does not rely a lot on oil, then you won't care about the investments in oil. So why should you? But that we see an issue in Canada, of course, that we have to address. We have to figure out how can we manage this kind of issue that we need to get transition to a low carbon economy on the one hand, but we don't want to slash the whole economy. So overall, I think there's quite a progress in the field. Of course, for me, it's too slow. But I'm not in. If I'm an academic, it's always too slow. But I think especially after Paris 2015, there were massive changes, and we have seen the financial industry addressing climate issues, especially now with the social issues, diversity, equity, inclusions. I think we see some progress as well. Think about 5 years ago when I talked to major lenders or Canadian banks and asked, okay, what are your financed emissions? Or investors as well, what are the emissions that come from your lending and from your investments? They would say, we don't know and we don't care, and we that's not our responsibility. No, it's our clients. That's not our business. In the meantime, all the 5 Canadian banks have subscribed the PCAF, Partnership for Carbon Accounting Financials, and they all track these financed emissions, and they take them into account because it's important, because it's a risk factor as well. And so you see in some years, I think, from my point of view, there's quite a development in the field. Also, many pension funds. I said that before. Funds that were named, responsible funds or ESG funds, now might be conventional funds now that do very similar things. So I would say there's some progress. What I must say is, well, I'm less in favor of the kind of defensive approach Canada often has in this regard. So now there's this big discussion on transition finance instead of sustainable finance. I can understand there's some reputational reasons and competition and issues as well, that might prevent them to use sustainable finance. But, if you compare yourself then to other countries and everybody does green and sustainable and you do transition, that's kind of, I don't know. Yeah, it's a bit, lagging behind, though, of course, transition finance makes sense, definitely. But there's a huge market, or there's a huge green bond market globally. In this case, Canada is lagging as well. There could be more on that, and I think there are many opportunities for for investments there. But sometimes that's what I would see in the Canadian landscape. So be a bit more proactive, and figure out, okay, how can we increase the amount of sustainable or finance or sustainable investment and ESG investment and responsible investment. So, but overall, you can get everything in Canada. So as a client, if you want to invest in the dark green and a light green and an impact in whatever you want, you can get it, and I think that's something that, advisors can help with. So let clients know what is available and what are the different options.
Great, thank you. Nalini, do you want to?
Yeah, just really
comment?
quickly,
Yep.
I agree with Olaf in terms of Canada not necessarily being a leader nor a laggard. We're somewhere in between because we're contending with a lot of our own, nuanced perspectives around the industries that we lead in, energy and so forth. So I think transition finance is a first good step, right? It's not as progressive as some of the other peers of ours, but they're also not contending with the same industries that we are. In terms of the US, I just wanted to maybe comment really quickly because I think what we're seeing in the US in terms of, this kind of what we call green hushing phenomenon. So there's been a lot of politicization of ESG and sustainability more broadly by the right-wing party in the US, and we see it manifesting in terms of how state pension plans are able to engage various asset managers. And so what's interesting about that is that there's this assumption that if you consider ESG as part of your investment process, ESG integration, what we've already talked about, that there should be assumption made that you are sacrificing the returns for the beneficiaries of these large state pension plans. And so we're seeing now conditions being put on what type of managers they can engage. All this to say is that I think the pendulum has now swung very strongly to the other side of the growth of what we've seen in this market. But I do expect it to kind of fall somewhere back in the middle. I think that this is a really normal phenomenon in the context of a space that is growing so fast over a short amount of time. I think regulation is trying to catch up. I think that expertise is not always there while trying to figure out what are the right constraints to put in place. We also, I would say a lot of the regulation, not just in the US, but globally that we're seeing around this space is put in place to combat this whole area of what they call greenwashing, people kind of jumping on the ESG and sustainability bandwagon saying, we do this, we do this, we do this, when in fact, none of their practices have changed. So while I'm supportive of combating this greenwashing, we also don't want to find ourselves in a place where, we're kind of demoting the importance and the usefulness of understanding sustainability and ESG risks.
Right. Okay, thank you. Just to follow up, I think you've kind of answered it, but I mean, how important is government or a supportive government policy and regulatory environment to the future of sustainable investing? And just any thoughts, I don't want to get political here or anything, but as to what a conservative wave in the US later this year or in Canada next year might have on the near future of sustainable investing and government policy and the regulatory environment.
I think one main issue here is, especially if you look at Canada, is that we all think that national policies are super important. I don't think so, to be honest. What you see now with the new European Union regulations, many Canadian companies are affected and they have to start to report ESG issues and all that stuff, because they have businesses there. What is the main drive from fossil fuel investment point of view? The main driver will be whether clients will buy the oil sands or not. And so, depending on what, and I think today Biden came up with a kind of a CO2 reduction regulation in the energy industry. This will be the drive. If there are any regulations against using oil, whatever we export, that's the main thing. And what can the Canadian government do against it? Not much. We can pump in more money into a sector that is internationally on decrease then, but that won't help. So I think there's something, of course, that the government can do, and I think especially on reporting, there is something on certain regulations as well. And finally, what I would see mainly is to provide a model for what is the future direction to go. I think we cannot expect from the banks, from asset managers, from investors to be the sustainability police or strategist of Canada. They need a guideline and a political framework that they can follow, and then they will do. They won't say, okay, we want to transition to a low carbon economy. None of them will say we don't want to have that and we don't do any investments with regard. They will follow, of course. So I think there's something we need to, on the one hand, I would say, domestic policies might be less important than we think. International or other main policies. On the other hand, I think we need certain guidelines and frameworks and policies from the government that show the direction where the country wants to go, and then investors investors can follow these directions.
Great, thank you. Nalini, do you have a comment on that?
Yeah, so from our perspective, I would say government policy is so important. And I think that it's needed to kind of move the needle in the right way and within the right time frame. I think, you can bottom up, try to engage with all of the relevant stakeholders who need to change their behaviors in a way to build a more inclusive and sustainable future for us all. But I think this top-down regulation is really what provides the impetus to see behaviors change. And so at our organization, we do both, right? So for all the investments that we have, we talk to each investee company separately around what their practices are today, if they're following best practice. And as a shareholder, we try to use our voice to improve better practice over the long term. So we can do this company by company, or we can work with policymakers and regulators and engage with them around some of the non-negotiables we think need to change sooner than later. And for us, it's very useful when, regulators have that informed expertise and make the right changes that are needed, because the knock-on effect across sectors and even regions is so needed in terms of making sure we're keeping on par with the action that collectively we need to do.
Great, thank you. We got a few questions on this topic from the audience. Actually, this one's more of a comment, but I'll say it anyway. Oh no, this is a question here. Any thoughts on the impact of the carbon tax in Canada and globally as it relates to these types of funds, and clients' thoughts that they are paying already for ESG type impacts?
The carbon price, of course, has an impact on a firm's financial performance. If you have to pay, that's costs. And these costs might have an effect on their share price. And then, there's an effect of the carbon price, so just financially. But again, if you have a company that is leading with regard to sustainability, they might be able to reduce their emissions in a way and might create a competitive advantage because of that, and then increase even their share price, inside a carbon market. And I think we have seen that the carbon price is effective. Of course, it depends on how it is done and how high it is, and also what the political message is behind all that. So I think this is something, again, if we talk about ESG or not. So again, if an investor invests in a company that is mainly operating in a country with a high carbon price, and they do not consider ESG, they don't just fulfill their fiduciary duty, because you have to figure out what is the environmental performance, for instance, the climate emissions of a company, because that might have material effects on them. And so I think that's again, that shows how important it is to use ESG, and it is not an add-on, but it's connected to financial analysis.
Okay, thank you. There's actually one more question that is, I guess, gets to maybe the landscape. And the question is, I believe the main hurdle with the ESG products is the validity and or accuracy of the ratings provided by the service providers. This is coupled with the more qualitative and non-directly observable nature of the S&G aspects of ESG. How do we navigate these challenges so that it is more convincing to customers?
I'm happy to jump in on this
Sure,
one.
sure, please,
So
yes.
as an asset manager, we work with a lot of these third-party providers that score individual companies through an ESG lens. And I'll say that this space has evolved significantly, but we're starting to see a trend in not putting, you know, your entire weight of the performance of a company based on scores alone. I will say for the S&G part of that question that they are actually quantified in those scores. It's not just looking at environmental performance. When you're looking at the score of a company, they are looking at qualitative factors around policy commitments, for example, on the S side, disclosures around workforce related, you know, labor trends and things of that nature, and especially governance. Governance has been a factor that I think the investment industry collectively has been tracking for a very long time. So I think the framing of scores and these third-party providers is a good first step for those that do not have the capacity to do kind of more in-depth bottom-up analysis of a company's overall prospects for performance. But I have seen a lot of leaps and bounds in terms of being able to quantify all three of these factors, including S&G, in a way to compare apples to apples. Obviously, there's always a bit of guessing. There's always still gaps in the data. And until some of these new disclosure standards come into effect, we're still going to be hypothesizing to some degree. So I think it's really important that whatever partner advisors work with in terms of asset management firms and the solutions that they offer, make sure that they have the requisite skill set in-house, so not to depend on scores in making the judgment calls around ESG factors for each and every investment.
Okay, that's great. Thank you. Okay, let's move on, please. Next slide. So we covered a little bit of this earlier, but actually we have a question from the audience that, well, actually, if you want to add to, I mean, I guess one of the misunderstandings that we talked about was the perception maybe that there's an incongruence between seeking, you know, the best possible returns for your clients and so, you know, investing for the betterment of society. Is that any other sort of misunderstandings that you'd like to address when it comes to sustainable investing? Yep. Nalini, is that can I direct that question to you? Yep.
Yeah,
Okay.
absolutely. To jump in. Yeah, there are a number of misconceptions. So I think people tend to put sustainable investing in a box alongside a number of other strategies used in investment management. And I think thinking of it as this niche style of investing or equating it to ethical investing or socially responsible investing, which are kind of iterations of where responsible investment started. When we think about the apartheid back in South Africa, that started a huge movement around boycotts and divestments. And then socially responsible investing was really thinking about companies that were excelling at their corporate social responsibility and things like that. But now we've kind of mainstreamed all of these things to say it's just prudent risk management, it's sound investment strategy. So my hope is that this space of sustainable investing, responsible investing, at least at kind of the baseline level, becomes integrated into how we just talk about investing, especially investing for the long term, and that we can drop the adjective of sustainable and responsible, and it's just how we invest. So I think that is one misunderstanding. And then I also think that for, you know, professionals in this field, when they're working with clients who are trying to align their personal values to their investments, that is something that is akin to this space, but it's only one of like 7 approaches. So that's something we see manifest in the approach that we call negative screening. So if you're a client, if you hear from a client, you know, I really am worried about the planet that I'm leaving for my grandchildren, and they don't want to invest in any companies that are perpetuating carbon emissions, right? Then you're going to go look for a fund that excludes certain sectors and products and services from a traditional investment. And values-based investing is not sustainable investing. It's one approach. And so I think that's another misconception, is that advisors don't realize that you know, there's all these other approaches to sustainable and responsible investing that can work for all of your clients, not just those who are particularly concerned with one or two social or environmental factors.
Great.
Olaf, any
No, I think
comment
that
on that?
summarizes pretty well. I think, the main one of the misunderstanding is, as Nalini said, it's all the same. It's not all the same. So there are many different facets of sustainable investment. And for me, when as a client, the thing is that if I have some knowledge about what I want to do, the main disappointment that I have if I get into a branch or talk to an asset manager is that usually the people there don't know about it, to be honest, So they might have a very basic understanding. And this is why you have, the wrong advice. If they say, they have a look on a certain fund, they say, okay, that's a green fund, but why is whatever ABB on that fund? That's an energy company. And, don't do that because that doesn't make sense and the rating agencies do it wrong or whatever. No, it's not, because it's a different approach in that fund. So I think, we need to make sure that advisors as well, that professionals in the financial service know what the basics are, and I think this is really important because, as Nalini said, you will have clients that have, multiple different views on that stuff and have different, different wishes, and they want to have different types of investment, and you should be prepared to respond to them.
Okay, thank you. We have a question from the audience. I guess it's very in theme of what we've been talking about, but the question is, I think as an investor, where one of your primary drivers is socially responsible, ecologically friendly, environmentally sensitive investing, you may have to accept that overall return may have to be sacrificed somewhat as you remove many options off the table to choose from. It won't always be the case, but you must accept it could be. It allows you to be happy with who you see in the mirror and stay true to your principles and values. Any thoughts on that? And just on the theme, is there sort of empirical data that sort of looks at performance between sustainable investing indexes or funds versus sort of regular funds? I don't know. Is there been some work done in that area?
If you have that approach, fine. You might have more opportunities. If you want to really have an impact, and there might be some types of impact that have lower financial returns, and you still want to do it, it's great. I don't say anything about it. So against that. So that's good. But overall, and there's a huge discussion in academics, now as well, of what the impact of ESG performance is on financial performance. And there's some back and forth. And again, it's in development. But what you can say at least, and I think that when I say that, I'm on the pretty safe side. I don't know studies that show that ESG cannot be just on par with conventional investment. So I don't see any that really show ESG is worse. I think we maybe have to be careful in saying ESG creates a better performance at the end, and depending on the definitions and all of that. But I think, the vast majority of the studies show, okay, it is not, financially, it kind of doesn't matter. And, there are many theoretical aspects, as Nalini said as well. If we exclude industries, this might decrease the total investment, the total investment. But, usually that's a very theoretical approach, and usually you can manage these things. If you have if you exclude 2 or 3 industries, that doesn't mean that you're not able to create a portfolio that has a good risk-adjusted return. So in a way, I think, again, as the participant said, if he or she is that's her strategy or his strategy, great. Let the advisor know and say, okay, I'm willing, to sacrifice some financial return if you can show me that I have a really great impact. That's great. But again, then we need also advisors that come up with a good solution for that. And yeah, I think we cannot say again, the empirical data doesn't say one is conventional is much better than ESG or ESG is much better than conventional yet. But we will see in the future. You can find examples, of course, in both directions, depending on what your kind of ideology was when you started when you started the analysis. We found, for instance, higher outperformance of excluding fossil fuels in pension funds over 2 years over 10 years, for instance. And there might others that come, okay, I have these 20 years and I found the other way. But I think there's good empirical data so far.
Okay, Nalini, do you want to add something?
Yeah, I think that it's a bit of a difficult question because I don't think you can characterize, again, all ESG factors or areas as contributing to underperformance. I actually have seen funds that have outperformed. I've seen funds that have underperformed. It really, again, depends on the approach and what the client is looking for. So I think when you went through that question, there was like a number of social and environmental factors listed as being important to that particular client. And if it was, and if we only took a negative inclusion approach where we kind of cut out any products and sectors related to any of their values, then yeah, you're of course shrinking your investable universe and you're not going to benefit from the outperformance of those products and sectors. And the more you have, the more you do that. So in some cases, yes, in some cases, no. But again, that blanket statement kind of concerns me. I think you have to look at the investment objective of the product in question before you kind of draw that conclusion and compare it to the market cap weighted equivalent in terms of the benchmark that they're following. And from my understanding of academic research and meta studies that have been done, I agree with Olaf that it's been usually a neutral to better result when you look at long-term performance of companies who are managing their ESG risks. And of course, also it's cyclical. So I'd say in a year like 2022, where energy really outperformed, and there were certain sustainable funds that underweighted energy given their environmental effects, they would not have outperformed their equivalent peers. But if you look over a longer time period, to Olaf's point, that's not true. So we have to be consistent about the time period, the funding question, and what is being incorporated into that solution in particular.
Okay, great. I think for the sake of time, we'll just move on, please. Next slide. Yes, well, why is it important? I mean, we've talked about some of the reasons, but why is it important to integrate ESG factors into asset management? I think particularly for investment advisors who I think comprise a large part of the audience here today, I guess how do they, what is the advisor's even responsibility? I should say for investment advisors in the, I'll speak on behalf of CSI, ESG investing is now part of the competency profile of advisors. It is sort of baked into the so the knowledge and skills that they need to have. So clearly it's recognized there. But maybe you could just talk about how they should deal with clients. Is it their responsibility to educate clients, or should they be more reactive or proactive, or yeah, go ahead.
So I think you're jumping ahead to the next question, which I'm happy to answer on the next slide first. But maybe I'll talk a little bit about asset management and institutional investors. I know it's not 100% aligned to the advisors on the line, but I think to understand the history of how things become normalized in mainstream, it really starts with the institutional investors. So institutional investors have a fiduciary duty to the beneficiaries who are akin to the clients that advisors are dealing with, right? Your everyday dentists, accountants, you
Mm.
know,
Yep.
family homes that are trying to save for retirement. So when we see institutional investors mobilizing, and they have been mobilizing since 2006 around responsible investment and environmental, social, and governance factors in a very consistent way, not having any specific mission or value associated with their organization. So we're not talking just per like church pension plans or foundations and endowments and philanthropic organizations. We're talking about mainstream pension plans like the teachers fund or police funds and things like that. When they are making ESG table stakes as part of their overall investment strategy for the benefit
Yep.
of their beneficiaries, we know that there is some logical rationale behind this that goes beyond wanting to make the world a better place. And so they sit at the top of the investment chain from our point of view as asset managers. And so we're responding to that kind of demand that has been coming in with full force since around early 2000s. And this is not necessarily only looking for products or solutions that have the title of sustainability. They're just saying, we want to make sure from a risk management lens that our liabilities and investments are protected. And so asset managers, you need to kind of up your game in understanding these factors. So it's kind of part and parcel of what you do for us. So that's maybe the first kind of context I'll provide. And then Marshall, to your second question around advisors and kind of how do they then take this phenomenon and this growing expectation that ESG is table stakes for investors. I think it's about creating two-way dialogue with clients, right? You want to kind of balance pushing something down the throat of a client who's not showing any interest, but also being ready and able to discuss the plethora of strategies in the space should a client approach you with questions or want to learn more. And I think something you said is really key. So I'm really happy to hear about CSI incorporating this into their
Yep.
courses. I think we actually have to do more for all of the gatekeepers in the financial community. So not just advisors, I'm thinking about investment consultants, financial planners, anybody who's on the front line. I feel like they have so much power and influence in terms of pushing the space forward and mobilizing capital for the areas that we need to see investment go into. But they cannot do their job unless they're equipped with the tools and the resources and the education to understand that sustainable investing, responsible investing is one thing. It's much more. It's nuanced, understand all the different approaches, work with asset managers to educate you since you're their client, and then pass on that wisdom when you're engaging with your clients.
Great. Olaf, do you have anything to add to that?
From a practical point of view, I agree. One kind of broader argument maybe that can be used, that they integrate is there's just recent paper as well that says, climate change alone decreases our income by 19% in the following 25 years. So there's a massive impact on that. And if you see that, that means, okay, if you don't care, you will lose money anyway. So if you say you don't care about all these things, then there will be an effect in the future anyway. You can still, of course, you can always argue long-term, short-term, and all these things, but I think as a general approach, and also to show maybe as an advisor to clients and say, there is an impact of that. It makes sense to do that from a financial point of view. And also institutional investors as a pension fund, for instance, if I invest and my beneficiaries will get the returns in 25 years, there's a strong case to integrate these risks and opportunities into your investment decision, because there might be income taken away in the future just if you ignore these things. So that's something that's very, very, very broad. When Nalini knows the daily business approach is much better than I do.
Yeah. Okay. What? Just thinking, it might not be a bad idea for CSI to create a structured discussion that advisors could have with their clients. Well, maybe we'll follow up with with you after this after this call is, might be something that that could be helpful. We're just about out of time, but there is a couple of more, if it's okay, maybe just a couple more minutes. There are some questions that I haven't gotten to. So maybe we can go to maybe 105, if is that possible? Nalini and Olaf. Okay. One question is, will IFRS efforts re sustainability reporting result in, one, a requirement of public entities such reporting, and or two, an expectation of such reporting?
I guess so. you know, and I know that there's research going on municipalities as well and their reporting, and so. But I think what we have seen, that in other standards as well, that started from a corporate level, that they will be broadened to other entities as well, and so I think so.
Okay. Nalini, any comment on that question?
Yeah, I know this is exactly what we want to see in terms of industry standards and regulations that are going to move the needle in a really useful way. We're going to get more decision useful information as investors as we analyze these companies now providing this new information. So very supportive of the IFRS and then mainstreaming the concept around sustainability disclosures. But it will take still some time until we see it consistently applied across the public sector.
Okay, here's another question from the audience. I find there is an incongruence in terms of decarbonization and the habitual exclusion of nuclear from ESG. Can you speak to the internal inconsistencies within the ESG frameworks?
So maybe I'll take this because I think we've seen a big change actually just in the last 2 years in particular. I think when we think about green taxonomies or what we consider to be the type of technologies or industries we want to invest in as we transition away from fossil fuels. Everybody is agreeing, including ourselves, that nuclear is here to stay and is no longer ostracized in the way it previously has been. So it's actually now being included. We just saw the Ontario bond framework be released for provincial green bonds, and they've included it there. ICMA, which is another standards for green bonds, have also done the same. So it's actually radically changed just in the last 2 years.
Okay.
Again, I think again, I think it's a matter, it's a question of what you want. If there are some that say, I don't want to have nuclear in, that's legitimate as well. And then we have to respond to that. And it's by the way, it's not by far not agreed upon that nuclear is a useful technology to address climate change. So there again we have different views on that. There are just recent studies that say we do not need it at all, and we can go without it as well. But as well, that's something and I don't want to decide on that, and that's not my also not my what I should do. But again, I think advisors should be prepared to have people that think we should integrate it and others that don't think that it should be integrated. And also, those that might make financial products should be prepared to address these different views.
Okay, great. Maybe just one more question from the audience. Has ESG been diminished? Do you think sustainable or responsible investing, I believe it says, has become a base, and really one must move towards exclusionary or impact investing? Many organizations are becoming ESG or referencing their ESG impacts, risks, etc. At what point is looking at ESG just part of evaluating an investment? Are we there yet? How close are we?
From my point of view, go ahead.
Sorry, I was just going to say, I think you're absolutely right about ESG is just part and parcel of sound investment strategy and an analysis. So I agree with that second point. And I do think that there are investment strategies under the sustainable umbrella that go further, that want to drive measurable environmental and social outcomes that could be measured alongside a financial outcome. In terms of impact, I think there are amazing frameworks like the UN Sustainable Development Goals that are now being used to inform asset allocation strategies and things of that nature. So yes, I think the industry as a whole is going further. At least some actors are, and there are still some actors in my industry that are still figuring out how to make ESG table stakes as part of their standard investment process.
Right, great. Olaf, very quickly.
Not really anything to add to that.
Yeah,
I think,
okay.
yeah, it will be integrated in convention products, or it maybe already is.
Great. Okay, so I think that wraps it up. Excellent conversation today. This concludes our event. Thank you, Nalini and Olaf, for participating and providing your insights. If anyone in the audience has any additional questions, they could email us at designations@csi.ca. A replay of this event will be made available in the coming days. You could check our website. And for more information on other upcoming webinars, also please visit our website. So thank you very much, everyone, for attending, and have a great day.